Have you ever wondered how financial professionals measure the potential downside of an investment, estimating how much money could be lost on a given day or week? Understanding this risk is crucial for making informed decisions and protecting your capital. Parametric value at risk, often called VaR, quantifies investment risk by estimating the maximum potential loss an investment or portfolio could experience over a defined period, with a specified level of confidence, assuming normal market conditions and a normal distribution of returns. The core mechanism behind parametric VaR relies on statistical properties of historical data, specifically the standard deviation of returns and the correlations between different assets within a portfolio. This is why it is also known as the variance covariance method. It calculates the likelihood of an investment's value falling below a certain point by using these past observations to predict future price movements. The method assumes that the future will resemble the past, at least in terms of return distributions, and that these returns fit a normal bell curve distribution. This allows for a straightforward statistical calculation to determine the VaR figure. Practitioners use parametric VaR by first gathering historical return data for each asset in a portfolio. They then calculate the standard deviation for each asset and the correlation coefficient between every pair of assets. These values are then combined into what is known as a variance covariance matrix, which is a mathematical representation of how the assets move together. This matrix, along with the portfolio's total value, is then fed into a specific formula to produce a single dollar figure for the value at risk. A key insight is that parametric VaR offers an analytically tractable and computationally efficient way to estimate risk, especially beneficial for large, diversified portfolios where simulating countless scenarios would be cumbersome. While powerful, its main limitation stems from its assumption of normally distributed returns, which may not always hold true during extreme market events or periods of high volatility. However, its efficiency makes it a widely adopted tool for both internal risk management and regulatory compliance, allowing institutions to set clear risk limits and allocate capital effectively. Ultimately, parametric VaR provides a standardized, concise measure of downside risk by leveraging statistical analysis of historical data. This clear quantification empowers investors and financial institutions to make more deliberate decisions about portfolio construction, hedging strategies, and capital deployment, helping them navigate the complexities of financial markets with greater confidence.